Hi, this is Stanley from Value Invest Asia. If you're learning about how to value a company, one of the key ratio that you might learn about is the price to book ratio. A book value of a company is basically its net asset value or the equity of a company. It can be calculated by just taking the total asset of the company minus the total liability. You can sort of see it as the value of a company if it is to be broken up and sold off today. For example, if a property is worth $1 million but has a mortgage of $700,000 to it, the book value of the property would be $300,000. To calculate the book value per share, we will have to find out how many shares outstanding does a company has. For example, if a company A has a book value of $10 million and has a total share outstanding of 1 million share, then its book value per share will be simply 10 divided by 1, which is $10 per share. We can then figure out its price to book ratio by simply taking its share price divided by the book value per share. Going back to our example, if company A is trading at $5 per share, then it will have a price to book ratio of 0.5 times. This means that you can actually invest in company A for less than what its net asset is worth. This is not uncommon to be found in the stock market. Sometimes a company can trade below its book value if investors are just pessimistic about its prospect or feel that its assets are grossly overstated. On the other hand, a company can also trade at a higher price to book ratio, definitely more than 1, if investors are optimistic about the company future or feel that it will grow to become more valuable than its net asset over time. Typically, a price to book ratio is more suitable to be used on a company with assets that are more easily measurable. For example, financial companies like banks or insurance companies are generally used to measure using price to book ratio. Property companies and REITs are also good candidates to be evaluated using price to book ratio, given that it is quite easy to value their key assets, which are properties. However, investors must know the limiting factors of a price to book ratio, which is generally that price to book ratio doesn't tell us about the quality of the business, the prospect of the business itself, the quality of its asset, and definitely the quality of the management as well. And it is definitely not useful if a company has negative equity at all. Therefore, the price to book ratio should be used as just one of many tools in valuing and understanding a company, but never in isolation. So that's it from me. Till we meet again, invest safely.